Hello traders and welcome back. I'm Natalie MacDonald and you're joining me for the latest Sydney Direct with Dukascopy TV. I'm reporting from Melbourne this week and so I thought I'd catch up with Dukascopy TV regular Evan Lucas of IG. Evan Lucas, always a pleasure to catch up with you. Thank you so much for taking the time to talk to Dukascopy TV today.
Thank you for having me, Natalie.
Always. So we're talking China and that PBOC injection. Really, what does this mean for the actual economy and its present status, and also how they see it shuffling forwards, really?
Yeah, nobody actually was sort of calling for the fourth one. Look, internationally, and I was one of them, was actually saying that it was likely to happen, but in mainland China was not expecting to see a fourth cut in 8 months. Now, what have we seen? We've seen the reserve requirement ratio cut by 50 basis points to targeted places like agriculture and smaller micro business. Also 300 basis point cuts to financial services companies, equates to around about 650 billion renminbi, or around about 106 billion US dollars. Fairly substantial. And then they also moved the benchmark rate, so the lending rate and the deposit rate down 25 bips. So very much a positive move from a stimulus side, and the economic part of your question comes down to, yes, this will again move things like industrial production, it'll move things like manufacturing. Clearly they were not moving towards their around 7% GDP figure, and that was there. This, however, doesn't look like that's what it was done for. This is a reaction to what's going on in the markets. Friday was a clear example that the Chinese are very, very worried about the disorder exit that's currently going from their markets.
Well, you mentioned their markets, and we said prior to this interview, Chinese markets are getting smashed. There is literally no other way to put it. So how is this injection really likely to actually support that or try and lift that? Well,
that was the principal idea, was that, again, the part of the raises we've seen in Chinese equity markets is on the back of those three other cuts that we'd seen. Huge stimulus, huge movement. They have completely deregulated their markets. They needed to. They were very strongly controlled, obviously very much tied to how the central government wanted them to trade. So they have started to see, fiscal reforms and market reforms, which have been positive, but it has led to a very high leverage movement as well. And the concern was, look, despite what's going on right now, they were heavily leveraged on the upside, and there was a lot of buying, and depth screens were touched very heavily on the buy side. A lot of profit to be realised, and on the other side of the depth screen when they came out, which is currently what's happening, you are not finding buyers, and therefore you're getting slippage and real big hits to depth. The issue now is that this is a very bearish move. I mean, the Chinex has actually hit a bear market in 3 days. Shanghai has hit a bear market inside 10, so has the CSI 300. So the fact that we limited down today, the fact that you've seen that stimulus over what happened yesterday doing nothing to actually provide some form of floor in the equity market is a risk, and it is a concern. Yes, it will be good for growth, but this certainly puts the idea of 5 and 10, 5 cuts in the last 10 months is a very big possibility. China needs to slow this down, because if they do get disordered exit and a disorderly market, it will become a panic situation, and clearly we could be getting towards that market with what we've seen today.
So equity markets covered. Renminbi, what does this mean for the currency, and also this whole internationalization that China is currently attempting to undergo with the local currency?
Look, the renminbi will clearly still be pegged to the US dollar for a long time to come. They clearly haven't got to a point where they can probably unpeg themselves. I mean, the MSCI was looking at adding the A50 to the world index. People thought it was going to happen this year. It hasn't happened. So again, you wouldn't see an unpegging there. The interesting thing is, though, if you do look at the peg and how it's moved, it has over years, moved lower from around about 8 to 9 renminbi to currently around about 6.1. But it is very much locked in there. Any lower than that, and China becomes uncompetitive, and they know that, and they clearly are trying to hold that against the Aussie. If you want to look at it, clearly it's less pegged, and it's moved to around about 420. Was as high as 8 renminbi, and that's clearly not as much concern. But that pegging will be there. The currency very hard to trade. It's more about the equity. And you look at the north-south trains from Hong Kong, they're the ones to watch. There's a lot of transaction there, over 2 times the trading volume of the S&P. So clearly people want leverage to China. The question is, has it gone too far?
In terms of that competitiveness, and you mentioned there sort of the renminbi, Aussie dollar, China, key trade partner. What does this actually mean for that relationship, on our part as well, and for Australians' domesticity?
The relationship is actually not as strong as it used to be. Clearly, we are a commodities country. And we do get 33.5% of our exports to China. and they are and will be a major part of that. They are also very influential on our Aussie dollar commodity side, but also on a trade-weighted basis, because they are pegged to the US, means that the Aussie dollar also moves to what the Chinese do. So there is that there. The interesting case at the moment is that we have somehow separated from that. We are trading on global issues and global markets. Clearly, the fact that our equity market is a defensive income play is becoming popular again. Clearly, the fact that there is risk to be traded, they're also moving there rather than actually looking at the fundamental plays that come in there. So economically, we'll still be tied there for a while, but unfortunately, if you look at markets right now, that correlation is broken down.
Evan, always a pleasure to catch up with you. Thank you so much.
Thanks, Natalie.
Our thanks, as always, to the team at IG. That's all we've got time for right now. Goodbye.